In today's session, we're going to continue on the concept of synchronous management. Today's session is the last session in a series of 14 different principles. Today's 14th principle talks about operational measures. And the statement says throughput should be going up, inventory should be going down, operating expense should be going down, ideally all at the same time. However, it is possible and maybe even desirable to have one of these measures go in the wrong direction in order to improve another one. So let's dive into this a little bit deeper. So first of all, let's talk about throughput. So throughput is the rate that the organization generates money through sales. So it's not putting products in the inventory, it's selling the products going out the door or the services being provided. That's throughput. How we calculate that is we take the raw material that goes into the product or service and we subtract that from the selling price. That's the easiest way to do it. The exact term is calculating by subtracting the totally variable cost from the selling price. If we take the selling price minus the totally variable cost, that gives us the throughput when we get sales for those products or services. So the totally variable costs that increase as a result of producing one more unit of output. So that's what totally variable costs are. And in manufacturing, it's typically raw materials, freight paid by the company, commissions, and outside processing. So those are the only totally variable costs I've ever found. Next, let's talk about operating expense. So operating expense is all the money that the company spends to convert inventory into throughput. So it's basically all the money the organization spends to keep the doors open. It can be calculated by taking all the expenses, direct labor, indirect labor, salaries, taxes, insurances, benefits, rent, utilities, all those things that company spends to keep the doors open is called operating expense. And lastly, investment. So investment is all the money that tied up in the organization that convert raw materials into finished products and sell them. So it's the summing the total assets plus the raw material cost of inventory. So the reason we use raw material cost of inventory because that's truly the investment, because the value-added components described as labor, overhead, and those that are included as part of the operating expense, not part of the inventory. So don't allocate costs to the inventory when you're figuring out your inventory investment. So what are the measures of effectiveness? So when we look at applying these measurements in the organization, whether it's to the strategy or improvement initiatives or daily activities, our measures of effectiveness are applied to the company as a whole, and in the context of how they relate to profits, cash flow, and return on investment. The two measures for net profit and return on investment are net profit is our throughput minus our operating expense, and return on investment is the change in throughput minus the change in operating expense divided by the change in investment. So when we're calculating the impact of improvements, of course, we're looking at it from a global perspective, not a local perspective. Our two global measures are change in throughput, change in operating expense. We can get the net impact on profit by looking at the change in throughput minus the change in operating expense. And of course, the return on investment is that net profit divided by the change in investment. So let's look at some examples. So let's take our first scenario here. So our sales in the current organization are, of course, 100%. Our totally variable costs are 30%. Our throughput then becomes 70%. Sales minus totally variable costs. Our operating expense to convert the inventory into throughput is 65%, so our net profit's 5%. So let's say we go and make an improvement in throughput by 25%. So of course our totally variable costs go up by 25%, so that's 37.5%. Our throughput goes to 87.5%. And let's just say in this example, our operating expense goes down by 2.5%. So our net profit goes to 25%. So it goes up 5x. Now another scenario would be, okay, our operating expense doesn't go down, our operating expense actually goes up. So it goes up by 2.5% to 68.5. What's the impact on net profit? Net profit goes to 19, which is still almost a 4x improvement in net profit. So now let's look at that from a return on investment perspective. So let's just do scenario one. Let's just say throughput, that 17.5% represents $475,000. Operating expense of 2.5% worth $250,000. And in this case, our inventory has to go up. So let's just say we want to take and make some strategic investment in inventory because of supply chain issues, increase our inventory by $500,000. So in this case, we do the calculation and our return on an investment of increasing inventory by $500,000 is 1.5 years. Now, scenario 2, same thing, our throughput's going up by 17.5%. Our OE goes up in this case, so we need to add extra operating expense to get that improvement in throughput. So our operating expense goes up to $250,000. Let's say our investment in inventory, we reduce inventory by $1 million. What's the impact on that? So our impact on that is like less than a quarter of a year. So if you look at your organization, you want to look at these 3 measures, and ideally they want to be going throughput up, operating expense down, investment in inventory or capital equipment going down. If that isn't possible, you might want to increase one of operating expense or investment to increase throughput at a faster rate. So that's our series on synchronous management. I hope you enjoyed the series. Hope you learned something. Next week, we'll start a new series on a different subject. So thanks everyone for joining these sessions.